Right friends, welcome back to Banking Awareness, lecture module number 13. This is a snapshot on banking operations. We are going to discuss about monetary policy, and the minor points which we are going to discuss here include the fiscal policy, monetary policy, CRR and SLR, repo and reverse repo, marginal standing facility and bank rate. Right. So let us look at this once again. Bank deposits we have discussed, then loans and advances we have discussed, priority sector lending we have discussed, and what is leftover is this monetary policy. And all of you are well aware about CRR, SLR, repo rate, reverse repo rate. These are part of monetary policy. That means banks are required to keep certain money aside in bonds form or gold form or cash form. That is a part of monetary policy, and we are going to discuss in this class what is meant by monetary policy. And before going into monetary policy, all of you should have clear idea about what is the fiscal policy, what is the monetary policy, what is the structural deficiencies in the system. Why I am introducing these three things is, for any country to grow, fiscal policy should maintain certain macroeconomic indices. That means the fiscal deficit should not exceed certain limits. And if you look at the monetary policy, the circulation of money in the system, structural deficiencies in the system, that means there should not be infrastructural bottlenecks, and this is another reason why the countries are not growing. So for a country like India, these three are very important. One is fiscal policy, second one is monetary policy, third one is structural deficiencies in the system. Countries like India cannot grow if any one of them is missing. So let us look at what is meant by fiscal policy. Fiscal policy is the prerogative of Ministry of Finance. RBI has got no role in it. What is exactly fiscal policy? Fiscal policy is nothing but the gap between expenditure and the revenue. For a developing country like India, for emerging economy like India, there will always be a gap between expenditure and revenue. Expenditure is normally more and revenue will normally less. So the gap is known as fiscal deficit. Fiscal deficit should not be too high. If fiscal deficit is too high, what will happen? Most of the government's income will go for interest payments. Very less will be left for development in the country. So fiscal deficit, sometimes you hear about finance minister's statement that the fiscal deficit will not exceed 3.9% this year, 3.5% next year, something like that. The meaning is the fiscal deficit should not exceed a certain percentage. Probably for this year it is 3.9% of GDP. That means the gap between expenditure and revenue should be limited up to some extent. Any government will try to look at improving the revenue and reducing the expenditure. It is true for any household expenditure also. Expenditure should be reduced as much as possible and revenue should be increased as high as possible. So the gap should be reduced. That is fiscal deficit. Any government as part of fiscal policy will try to reduce expenditure, will try to increase the revenue. So the gap should be reduced, and this is fiscal policy. Look at monetary policy. What is monetary policy? Monetary policy basically looks at preserving the value of rupee. I am talking about Indian currency. The main motto of monetary policy is preserving the intrinsic value of rupee. Value of rupee should not deteriorate fast. If I have 100 rupees today, the value of 100 rupees note should not deteriorate fast. Slight inflation is expected, but if I am getting dinner for 100 rupees today, if I am required to spend 200 rupees tomorrow for getting the same dinner, then my rupee value is lost. RBI basically looks at preserving the intrinsic value of rupee. That means inflation should be under control. Maintaining rupee value is basically reducing inflation. If inflation is increasing, rupee value will reduce. RBI as part of monetary policy will look at the rupee value and rupee value will be preserved if there is judicious availability of circulation of money in the system. Rupee value will be preserved if there is judicious availability of money in the system. The availability of money for circulation in the system should not be too high, should not be too low, it should be reasonable so as to strike a balance between growth and inflation. Growth should be there and inflation is also tolerable up to some extent. If inflation exceeds certain limit, then my rupee value will reduce. Then what will happen? Poor man will suffer in the country. That's why inflation should not go beyond certain percentage. RBI gives target of 4%, 6%, something like that. So the basic purpose of monetary policy is controlling inflation and to preserve the value of rupee. Please don't forget. And what is meant by structural deficiencies in the system? Lack of infrastructure. That is inadequate infrastructure. In India, around 30 to 40% of vegetables and fruits are lost because there is no cold storage facilities. And many times farmers throw tomatoes on roads because there is no cold storage facility and marketing is also not properly available in this country. These are all structural bottlenecks. Rural infrastructure is poor. If somebody is growing vegetables, it is not that easy for him to bring it to the towns to have market. That is lack of infrastructure of roads. So, lack of cold storage facilities, lack of proper roads, lack of proper transport infrastructure, these are all structural bottlenecks. Because of structural bottlenecks, economies will suffer. So, India is facing this problem because of lack of infrastructure. So, fiscal policy by the Ministry of Finance should be prudent and should live up to the expectations. Monetary policy, which is the prerogative of Reserve Bank of India, should look at optimum availability of money circulation in the system so as to strike a balance between growth and inflation, and government should eliminate structural bottlenecks. Right? So, these three things are very important for economy like India, and let us limit our discussion for this monetary policy. Right? Monetary policy means to preserve intrinsic value of rupee, indirectly to control inflation. Rates should not increase. There should be some limit. That is the main purpose of monetary policy, and I am confining my discussion to some aspects of monetary policy, and there may be some other aspects which are rarely used by Reserve Bank of India, and I am not going into those aspects, and I am limiting my discussion to reserve ratios, policy rates and open market operations. Reserve ratios, policy rates and open market operations. And these three are part of Reserve Bank of India's monetary policy, and let us look at what is the reserve ratio. All of you are well aware, certain percentage banks are required to keep in cash form. They are not allowed to use that money. Certain percentage, it may be 3%, 4%. I am not sticking to the figure because of the reason tomorrow it may change. And at present, certain percentage is required to keep. Certain percentage of money is required to be kept in cash form as a special account with Reserve Bank of India, and similarly, certain money is to be kept as a statutory liquidity ratio in either cash form or as gold reserves or as government approved bonds. So, certain money in cash form, certain money in 2-3 forms is required to be kept, and the percentage as announced by Reserve Bank as part of its monetary policy is called reserve ratio. These two are reserve ratios, CRR and SLR. These are reserve ratios. And remaining things I have given in this PPT, please go through them. But I would like to tell you what will happen if CRR or cash reserve ratio is decreased by 1%. If CRR is 4%, if it is decreased to 3%, what will happen? if RBI reduces CRR by 1%, what will happen? That means 1% of money in the banking system, 1% of deposits in the banking system will flow to the market. That means RBI releases around 80,000 crores. Banks will have additional money of 80,000 crores of rupees if RBI reduces cash reserve ratio by 1%. That means more money in circulation. And because of which interest rates will come down. When interest rates are coming down, then there may be more demand for goods. When more demand is there, what will happen? GDP will grow. But when more demand is there, it will lead to demand pull inflation. When growth is there, inflation also will go on parallelly. That's why RBI will strike a balance. RBI's present CRR is 4%. If they reduce to 3%, then 80,000 crores of rupees will be available additionally in the banking system, which may lead to additional demand, which may lead to additional growth. But what will happen? Because of additional demand, demand pull inflation will be there. Because of inflation, common man will suffer. That's why RBI has to strike a balance with regard to the circulation of money in the system. That means they have to strike a balance between inflation and growth. Look at case 2. If CRR is increased by 1%, at present it is 4%. If it is increased to 5%, what will happen? Then 80,000 crores of rupees will be sucked by Reserve Bank of India and money circulation in the system will be reduced, because of which interest rates will increase, because of which growth will be reduced and inflation may be under control, but when growth reduces, unemployment will increase. So that's why RBI has to strike a balance between growth and inflation. So this is about the CRR. Similarly about SLR. If SLR is reduced by 1%, 80,000 crores has to flow into the market. But with regard to SLR, theory and practice may differ. That means 80,000 crores may not flow directly into the banking system if you consider SLR, because of the reason banks have got a habit of investing more in government securities than required. But theoretically I am telling here, but CRR will have immediate effect. SLR may not have immediate effect, but for a theoretical case only I represented here graphically. So if CRR, SLR are reduced, more money will flow into the system. And if they are increased, money will be sucked by the Reserve Bank. Right? So that's why RBI has to strike a balance. And look at the policy rates. Policy rates are repo rate and reverse repo rate. And please don't forget, these two are called liquidity adjustment facility. No bank knows how much money they require by evening. Some customer may withdraw more. Some customer may deposit more. So banks by evening may have more money with them, or they may require some money. So as to facilitate borrowing of money for short term, this repo rate is devised. Repo rate and reverse repo rate are part of liquidity adjustment facility. That means if banks are in need of money for short term, then they will borrow from Reserve Bank of India at the interest rate as decided by the Reserve Bank of India. Often you hear about repo rate. Repo rate is 6.75, 7.25 like that. That means when banks are borrowing from Reserve Bank of India for short term, they have to pay that much interest. What is reverse repo? One day banks may have more money. What will they do? They will park with the Reserve Bank of India and they will get some interest from Reserve Bank of India for short term. Please don't forget. And these two are part of liquidity adjustment facility, and under repo rate only banks can access up to certain limit only from RBI. And please don't forget, repo rate is the rate which gives a signal to the overall interest rates in the market, right? And I have told you there is some limit for accessing the funds under repo rate. If that exhausts, then another facility is given, that is the marginal standing rate or marginal standing facility at a slightly higher rate. Marginal standing facility interest rates are 1% higher than repo rates. Reverse repo rates are 1% lower than the repo rate. And please don't forget, in the banking parlance, percentage is sometimes expressed in basis points. 1% is 100 basis points. If someone says 25 basis points, it is 0.25%. If someone says 50 basis points, it is 0.5%. Please don't forget, 1% is 100 basis points. And after exhausting this facility under repo rate, banks can still access Reserve Bank of India for short-term borrowing, that is the marginal standing facility. The interest rate is 1% higher than repo rate. And if that is also exhausted, then they can approach another bank or another financial institution which is popularly known as call rate. So, repo rate is the rate which gives a signal to the market with regard to the interest rates in the banking system. Please don't forget. Look at the bank rate when financial institutions are borrowing for long duration from Reserve Bank of India, that is bank rate. The interest rates for bank rate and marginal standing facility are the same, right? If you look into this, it will be clearly evident to you. The rates of MSF and bank rate are higher by 100 basis points in comparison to repo rate, and interest rates for reverse repo rate are lesser by 100 basis points, right? As I have already told you, repo rate is the rate which gives a signal to the market, and if the repo rate is reduced, then banks will reduce their interest rates. In turn, there will be credit offtake from the banking system. And if repo rate is increased, banks will increase their rates, due to which credit offtake from the banking system will not be high. That means credit offtake is a must if you want growth in the economy, right? And look at the next one. Last but not the least is open market operations. What is open market operations? Open market operation is basically nothing but selling bonds and purchasing bonds. If RBI is purchasing government securities, if RBI is selling government securities to infuse or suck liquidity from the system, that is open market operation. Look at case 1. When RBI sells bonds, what will happen? When RBI is selling bonds, bonds will be there in the market and money will be sucked by the RBI. And if RBI is purchasing bonds, then bonds will come to the RBI and money will flow into the system. That means more circulation of money will be there in the system, as is evident from phase 2, right? So, these three are basically part of monetary policy, that is reserve ratios, CRR and SLR, policy rates. Policy rates are repo rate, reverse repo rate, marginal standing facility rate and bank rate, and open market operations. These three are part of RBI's monetary policy, basically to preserve the intrinsic value of rupee by controlling inflation. And please don't forget, because of the mechanism of statutory liquidity ratio, government is able to access money from the banking system so as to take care of fiscal deficit. Government market borrowings are indirectly facilitated by the statutory requirement under statutory liquidity ratio by the banks. That's why central government is able to bridge the gap between expenditure and revenue, as I have already told you, under the fiscal policy. Right friends, I hope fiscal policy, monetary policy and structural deficiencies in the system are clear to you after hearing to this lecture. So, With this, let us conclude this lecture. Please do join for 14th module in banking awareness. Have a nice day. Thank you.